Hi everyone. Trust all of you are doing good and remaining safe in this unprecedented times. Today, I bring a video to you on the TDS of the goods, which is governed by Section 194Q of the Income Tax Act 1961. At the same time, we will discuss upon the interplay of Section 194Q TDS on goods against a section on TCS on goods governed by section 206C 1H section of the Income Tax Act 1961. We'll try and establish what is the interplay between both of these sections. Both sections seem similar, the limits seem similar, but there is a difference between both of the sections upon the deductibility of the limits. We will also touch base upon the practical consideration and challenges for the corporates to enhance their systems and what are other related practical challenges and difficulties in the implementation of these sections. So Section 194Q was brought in by the Finance Act 2021, subsequently incorporated into the Income Tax Act of 1961 as section under 194 series. It seems government keeps on adding letters to section 194 in terms of tax deductibility and putting onus on the deductor who is working with the deductee. But there are challenges and considerations which any corporate or any individual needs to establish as a control mechanism in his or her internal working surroundings, whether it is the ERP, maintaining relationships, or communications at large with the vendor partners and your deductors or the deductee. Having said that, I will jump onto a presentation which I will use today to put across my views on the topic TDS and TCS interplay. Just waiting for the presentation to load. Yes, it is here. Yes, so like I said, I will be covering today and throwing some light on the section TDS or TCS on goods, establishing the interplay and the practical considerations around the same. Yes, section 194Q was brought in by the Finance Act 2021 on the purchase of goods, in which the deductor has the liability to deduct TDS on the goods purchased from the deductee or from the seller. Till date, we know that the TDS was always deducted on the services as such. Generally, what we have seen, 192, you can call any other section of 194, it is all about some kind of services or some kind of output generated, but it was not specifically on goods. For the goods part of it, there was always a GST, which was brought in by the government in 2017. But in 2021, government has added one more letter to 194, like I said earlier, it's 194Q, which focuses on the TDS on the purchase of goods. So I will take you through the provisions, what are the interplay and what are the challenges in the later slides. So this is applicable from 1st of July 2021. Just the next month today when we are making the video. So TDS on purchase of goods, it is applicable to every buyer. Suppose I am a buyer today, whether it is a transaction between business to business or whether it is a transaction between business to consumers, both should be liable to deduct tax at source. Then what do I mean by tax at source is the similar tax deduction at source, which generally our employers do in case of a salaried employee. You go for a contractor kind of business, their 194C becomes applicable. So there were various six sections on this already. It's just an addition in an event you purchase the goods from the seller. So the rate of tax which you have to deduct is 0.1%. Now there's a question that why the rate of tax is so low, and what is the uh, ulterior motive of government to come out with a 0.1% kind of tax rate? Is it going to give revenue such a high consideration in terms of the collection of tax? No. The only rationale or the idea of the government to come out with this kind of rate is to basically trace and track the transaction on the purchase of goods, which was not happening earlier, if you know. So it is applicable on the payments made to a resident. So you purchase the goods for a resident Indian on the sum exceeding INR 50 lakhs. So in case in the current year, you have brought goods more than 50 lakh rupees single transaction or a cumulative transaction from the seller, you are liable to deduct TDS under section 194Q at the rate of 0.1%. And in case the seller is not furnishing the PAN to you, PAN number, you have to deduct TDS at the rate of 5%. So we will come across the section why it is 5%, what is the rationale around that. But before that, I'm just trying to set the tone of this conversation or this topic today. The buyer is defined as a person. Suppose I'm a buyer. Buyer is defined as a person whose total sales, turnover, or gross receipts, any of the three criteria from the business exceeds INR 10 crores during the financial year immediately preceding the financial year. So suppose the year in the question is 21-22. So in the immediately preceding financial year, if the buyer's turnover, sales, or the gross receipt is more than INR 10 crores, he will be liable to deduct TDS. So the liability will automatically fall on the buyer of the goods and not on the seller of the goods. TDS deduction. What is the point of the TDS deduction? The point of the TDS deduction is at the time of the credit of such sum of the amount to the seller, and the payment can be made by any mode. It can be cash, it can be credit, whatever. But whenever it is being credited to the account of the seller, you have to do the deduction of the TTS. Even in a case the deduction or the amount is being credited to the suspense account, the liability to deduct TDS arises in that point in time, which is where 0.1% or 5%, as the rate suggests, has to be deducted before making the payment to the seller of the goods. Now, where section 194Q is not applicable, so this section is not applicable where automatically under section 206C, which was the erstwhile TCS, not erstwhile, it's a section still in play, but there was another section which was added upon, which is 206C1H, which I will be throwing some light on again, where a few of the materials on which you have to deduct TCS. It was tender leaves, the forest produce, mostly kind of unorganized sector where the rates of TCS were specifically specified. On those sections, 194Q might not be applicable. Beg your pardon, there's some problem in the slide. Yeah. So where TDS is deducted under any other section. Suppose TDS is deducted already under section 194, 194C, 194H, 194J, suppose 192. So in that case, the section 194Q would not be applicable. Suppose in an event, you have a scenario where you are standing at a crossroad where 194Q and 261H. So 261H is the section of the TCS of goods, then 194Q would automatically supersede in that event. Where TCS is collected under section 206C, which I said earlier. 206C continues to persist today. It is about a section on the unorganized sector, like tender leaves, the forest produce, etc. In that case, if TCS is already deducted, in that case, Section 194Q will not be applicable. In that case, Section 206C will supersede and not Section 206C1H. Now, I was throwing some light earlier that in a few of the sections, you need to deduct the TDS at the rate of 5%, which is a higher rate in proportion to 0.1%, which we were discussing earlier, right? So government is trying each and every logic so that there is no deficiency in the deduction of the tax or on the tracing of the transactions which the purchasers and the sellers are trying to do today, which is where the government has added a couple more sections in Finance Act 2021, which is Section 206AB and Section 206CCA, which throw some light on the deduction at the higher rate of tax, which is nothing but 5% instead of a 0.1%. Earlier as well, Section 206C threw some light where the buyer or the seller is not furnishing you the permanent account number, which is PAN. You had to deduct TDS at the rate of 20%, just to ensure that the compliance is there from the permanent account number perspective. Now, where it is applicable, Section 206AB and 206CCA is apart from the sections 192, 192A, 194, 194BB, 194LBC, and 194N. So these are the sections where, if in case the TDS is being deducted, you need not cover Section 206AB and CCA on the higher rates of deduction of tax, which we have discussed earlier, at the rate of 5%. Now, who is the deductor? Deductor is any person who is liable to deduct tax on the deductee, right? Now, who is the deductee now? On whom I have to go ahead and collect a higher rate of TDS? So the deductee is a person who has not filed the returns of income of the 2 preceding financial years from the financial year in question, and the due date for furnishing of the returns have got over now. So now the seller cannot go ahead and file the returns, which is what is non-compliant now. Now a question arises: how do I go ahead and trace whether the seller who is telling me, or maybe take it like this, that who has sold me worth more than 50 lakh rupees, the limit which we have discussed earlier? I will throw more light and examples in my upcoming slides. That how do I ensure that he has not filed his return of income? He can tell me tomorrow that, okay, I have filed my return of income. Why are you taxing me then at a higher rate? So government might come with a utility in which you just put the PAN number or you put the name of the supplier to you, seller to you. Automatically, it will throw you the information whether he is compliant or non-compliant as on date. So that is yet to come, but we think that that is going to come from the income tax management perspective. At the same time, the aggregate of the TDS or the TCS in both the last couple of financial years in which he has not filed the returns of income, the liability is more than 50,000 rupees. So this is a specified person case, that in case the person has not done both the things, is non-compliant, then in that case you go ahead and deduct the TDS at the rate of 5%. So I discussed on the rate of the tax, but I'll just take you through the section. Section tells you that twice the rate is specified in the relevant provisions of the Act, or twice the rates or rate in force, or at the rate of 5%. So in our case, since I am discussing about Section 194Q, it is 0.1%. Even if I take a double rate, it is 0.2%. So therefore, if I take higher of the following, it will come as how much? 5% as per the third parameter determining the section. I beg your pardon, there's some issue in the presentation, but we are working on it. Just one moment. Yeah. So we have already discussed this. Yes. So is TCS still applicable on sale of goods, right? So we were discussing, right? So they will discuss the interplay between 194Q and 206C1H. When I discuss about TCS, what is TCS? TCS is when the seller has to collect tax from you at source. So suppose a seller is selling goods to a person and the seller's turnover in the preceding financial year is more than 10 crores. At the same time, the goods which he is selling to you is more than 50 lakh rupees, then the seller has to deduct or maybe collect from you 0.1% of the value of the goods, which is more than 50 lakh rupees, right? Now the question arises, suppose in a case both the buyer and seller are having the limits higher than the limits specified in the act, which is turnover of 10 crores in the preceding financial year and more than 50 lakh rupees of goods sale transaction happening between both of them. Then what supersedes? Will section 194Q prevail or section 206C1H will prevail? We will throw some light on that. So sales is made to a customer from the seller. Suppose the sales to buyer is less than INR 50 lakh rupees in the financial year. So what happens? TCS and TDS both are not applicable, right? Because the limit which has been specified in the act is nothing but 50 lakh rupees, right? Now, where the sales to buyer is more than 50 lakh rupees, but the previous year turnover is less than 10 crore rupees. So I'm talking from a seller's perspective. So what is happening? Automatically, the section on TCS will not be applicable. Section on TCS 206C1H, if it is not applicable, automatically section 194Q will prevail, right? So if the sales made to buyer is more than 50 lakh rupees and the previous year turnover is less than 10 crore rupees of the buyer, now we are talking from the buyer's perspective, then TCS will be applicable. And what is the compliances for the seller then? So the compliances for the seller is monthly compliance. He has to file a quarterly return. There's section we have to do a clause 34A reconciliation in the tax audit report, and invoice versus collection. Whatever invoicing, whatever collection I'm trying to do has to be reconciled. And what is the compliance for the buyer? Because the seller has collected tax from the buyer, which is where the buyer has to go ahead and download the form 26AS for the tax collection at source, and he has to claim it in the income tax return, right? Now look at another scenario where sales to buyer is more than 50 lakh rupees, right? And the previous year turnover of the buyer is more than 10 crore rupees. So what we have discussed, as soon as the buyer's turnover is more than 10 crore rupees and the purchase is more than 50 lakh rupees, the buyer has got a responsibility on him is to deduct TDS at the rate of 0.1%. And in case the seller is non-compliant in the section 206AB, 206CCA at the rate of 5%, which we have discussed in the earlier slide. Now, what are the compliances for a seller? So now we are thinking from a seller perspective. So when I tell you from a seller perspective, what happens is I have to download the form 26AS, do the reconciliation to claim my tax deducted at source in my ITR. But there's a challenge here, that how do I know whether the buyer's turnover exceeds 10 crores? So this is a practical challenge or consideration which we will discuss in the next slide. Now, what is the compliance for the buyer? Since the buyer has deducted TDS at source at 0.1%, buyer has to do monthly compliance. He has to file the quarterly return. He has to update this in the tax audit report under clause 34A, and invoice versus collection reconciliation automatically comes into the fore, right? So This is a challenging situation that a section comes in, but there's a lot of compliances which comes automatically for both buyer and seller. Now let's discuss about some interplay scenarios here. And what are the interplay scenarios when domestic transaction happens between a buyer and seller who are residents, right? So let's discuss on a case-to-case basis now. So let's take a case one where the seller turnover is 7 crores, which is less than the limit of 10 crore specified in the section. So what will happen? Automatically, the seller is not entitled to tax the buyer at 0.1% or to collect the TCS at 0.1%. Automatically, what will happen? Section 194Q will prevail. But the receipt or sale of goods which was made to the buyer is 57 lakh rupees. So now the TDS will be deducted at 0.01% on the higher of 50 lakh rupees, which is 7 lakh rupees here in question. Now case 2. What does case 2 tell? Case 2 tells us that the seller turnover is more than 10 crores, which is 11 crore rupees. The buyer's turnover is less than 10 crore, which is 9 crore rupees. So as soon as I see this, automatically what comes to my forefront, right, is section 206C 1H is applicable, and the seller has got the responsibility to collect tax at source from the buyer at 0.1%. What is the amount on which he will deduct? Higher of 50 lakh rupees. The transaction in question is how much? 52 lakh rupees. Therefore, 2 lakh rupees is the amount on which I will have to go ahead and collect TCS in the perspective of the seller and tax 2 lakh rupees into 0.01%. Now, let's take a case 3 scenario wherein the turnovers for both seller and buyer are more than 10 crore rupees, the limit which we have discussed earlier, right? So suppose the seller is 12 crore rupees, the buyer is 14 crore rupees, and the receipt or payment is 58 lakh rupees. So we have discussed earlier is in case both section 261H is applicable, section 194Q is applicable, section 194Q will supersede section 261H. So therefore, in this pertinent case, section 194Q will supersede 261H of TCS, and the buyer has got the responsibility to deduct TDS at the rate of 0.01% on higher of 50 lakh rupees. The case in question here is 58 lakh rupees. So the taxable amount is 8 lakh rupees into 0.01%. So section 194Q will supersede the section of TCS 261H in case both the sections are applicable. But in case 206C is applicable, which was an erstwhile section, in that case, 206C section will prevail and supersede 194Q as well. Right? So there are challenges when I am trying to, go ahead and implement this section into my corporate from 1st July 2021. There are some challenges which a corporate needs to discuss and plan itself. Suppose if I'm talking about a small partnership concern, I'm talking about a sole proprietorship concern, you can still manage the things because the volume, the turnover, or the frequency of the transaction is limited. But what happens in the case where it is a huge MNC kind of a structure or it is a giant in its industry? What do you do then? So these are the challenges which a finance professional or a tax professional needs to keep in his mind while doing the transaction and accordingly record the transaction. So the key challenges are the turnover of the customers. So we have to go ahead and gather the information of the turnover of the customers. You have to go ahead and check the IT return filing status. Right now, we feel that the government will come back with a utility wherein you can go ahead and find the credentials of the seller or the buyer on the website of the income tax. Put the name of the buyer or seller along with the PAN or without PAN. We are yet to see how government is thinking about this utility. If it does, you will get whether he is applicable, and accordingly, section 206AB and 206CCA will become applicable, and accordingly, you have to go ahead and file the maybe deduct TCS or TDS, correct TCS at the rate of 0.01%. They will also let you know whether the TDS or TCS liability was 50,000, more than 50,000 in both the preceding financial years when the return of income was not filed. Another thing is the system challenges. So system readiness has to be checked. The company has to start bifurcating customer master in ERP, whichever ERP the company uses, for the TDS and the TCS applicability. So updating of tax codes in ERP would be a mandate now. Suppose the transaction with a purchaser or a seller is more than 50 lakh rupees. What do you do? So earlier the rate of TDS was 10%, deducted in COVID era to 7.5%, but for TDS under 194Q is 0.01%. So you have to update the tax code master for that matter. Recording of transactions. The recording of transactions has to be very, very categorical because the section says that at the time of the receipt, whether it is receipt or booking, whichever is earlier. So automatically the section will become applicable. So recording of transaction is very important. So you have to tag it whether it is receipt or booking. Now multiple business scenarios. Suppose the sale is made in year 1 and year 2, but the payment is made received in year 2. So there's a lot of thought-provoking thought processes going around it. A government has come out, but government is yet to come out with a clarity on how will the applicability be smooth here. Suppose there's an advance payment which is being collected, and suppose at the end of the day I go ahead and cancel the PO which I've issued to my vendor or my supplier. What does happen then? I will be entitled to deduct a TDS or the TCS as the case may be. But in that case, what is the respite or what is the corrective measures and SSES that is yet to be discussed by the government. There's a lot of reconciliation burden which is going to come. Reconciliation would be in the form of Form 26AS reconciliation for the TDS or TCS to be claimed back from the ITR, and Clause 34A reconciliations in the filing which we do for the tax audit report, right? Another pertinent practical challenge which is not yet cleared by the government is the definition of goods. Government has told on the purchase or sale of good for more than 50 lakh rupees. What you determine, what is the definition of good? But safe to say now, definition of good would be something which is movable in nature. There is no comment which has come from the government in terms of whether the good is movable, immovable, but from a safety perspective, we will take it as movable at this point in time. For sure, it does not include the intangibles as of now, but we'll never know what is the intent of the government in capturing the transactions. But the entire intent of government to bring both of these sections, Section 26C1H was applicable from 10th of October 2020. Section 194Q is applicable from 1st of July 2021. So in such a short era of time, government has come ahead with a couple of sections back to back. What is the intent? So the intent of the government is to trace and track any kind of transaction happening between the buyer and the seller, which were otherwise not coming under the purview of the government, and then make some revenue on this. Another thing which we think from a thought perspective is, if Section 194Q is a success for the government, and if government is able to trace and track all the transactions in the manner in which it wants to, then in that case, Section 206C1H might become scrap. But we have to wait and watch for that. But currently, this is what the scenario is. So good sections in terms of tracing and tracking the transactions, but there lies a lot of practical challenges and difficulties in implementation of the ERP, tracking and tracing the internal transactions with the buyer, and lot of reconciliations coming your way. So there's definitely an increase in the complexity due to the tracking of high volume transactions and the fragmentation part of it. Thank you. For any other kind of questions or the queries you might have, you can type your queries in the comments box section, and we will take your queries. We will revert your queries as and when the time permits us. Thank you. Have a nice day.